Hello and welcome. My name is Claudia Zeisberger. I'm professor of entrepreneurship at INSEAD, where I do work on anything related to private capital, in particular venture capital. And the conversation that I just recorded in an earlier video was all around why venture investing is not equal to private equity investing. So if you haven't seen that video yet, I encourage you to watch it first, because we have right now in the studio with us Kamal Hassan, who is the founding partner of Loyal VC, one of the prominent early stage investors that invests globally. Kamal, thank you very much for making time and welcome.
My pleasure.
So what we would like to do, have a little bit of a conversation, someone who lives this on a daily basis. Why is VC not equal to private equity? And you have over 20 years experience investing in early stage companies. And I assume you were one of the first ones actually who talked to me about that. I assume that conversation comes up regularly in discussions with your investors?
It does come up a little bit with the discussion investors. I think the big thing is that I had my experience at Bain Co, and I think most of us have a corporate experience, and we are very ingrained in how corporates work, and corporates are very predictable. And PE is acquiring corporates, and again, it's very predictable. And certainly I discovered when I was investing in venture deals, when I started with angel investing, just my own money, I thought that I could sort of change how things happened and make the industry individual deals much more predictable. And I discovered the same thing that millions of people have discovered before me, which is creating things is very different. I think it came from personal experience and the personal understanding that what I lived at Bain and what I was living as an angel investor are two different worlds, and started thinking about what those differences were.
And I think that's a really interesting comment for all those retail investors that are nowadays looking more and more into getting closer to the private capital space, especially venture capital. So I think it's really important to go into this asset class with eyes wide open and to understand what it does and what it does not do. Now, the riskiness of venture capital, and I like to say, for those coming from the public equity market or the derivatives market, that doing early stage venture investing is a little bit like buying very low delta options. So with a low probability of ending up in the money, if I use derivative language. So would you agree with me on that? Is this a really kind of a risky bucket of an asset class?
So I think a lot of people confuse the assets and the asset class. And I agree 100%. The assets are individually risky assets. I don't think enough people put thought into the asset class investing, because that's about building a portfolio. And you can use the rules of good portfolio construction to actually build much lower risk asset, sort of a low risk portfolio within the asset class. And you see this all the time. And we've got pension plans who are putting 10% or more of their assets into venture capital. Pension plans are not rewarded for making risky investments, and they use fund of fund type activities where you invest in hundreds of underlying assets to then take the risk out, because sure, going back to your options, you might have a 3%, or I guess in our industry, it is a 4% chance that the option pays out. Well, if you have a 4% chance that any one option pays out, well, when you buy 1,000 options, all of a sudden that's not risky, whereas buying one option is extremely risky. You've only got a 4% chance of the payout. So I think that's what people need to remember, is that there's a 4% chance of a home run in our industry, and you want to build a diversified portfolio of home runs. So just multiply. If you want a portfolio of 20 companies, you multiply by 25, 500 investments. That's the sort of thing which you should be thinking about.
And when you and your co-founders set up Loyal VC, you kept that in mind. You took that into account and you said, okay, we need to get a foot in the door with a large number of startups. And the process that you came up with was to find a source of good founders and startups and invest a small amount, $10,000, very quickly into them. No pitch required, nothing. So if a founder came out of the Founders Institute or out of INSEAD, if I forget one, let me know. Then basically those founders became part of that group that received $10,000. Now, at a later stage, then they received more, but I'll let you now explain how the process works.
Yeah, no, so, I mean, that's absolutely right. We do only the two sources, Founder Institute and INSEAD. There's a big difference between those two sources. In Founder Institute Global Accelerator Program, we fund the top 2% of the graduates who come out of that source to us. In INSEAD, we're funding about the top 40% of the INSEAD graduates who come to us. But what we're doing is we're trying to invest at scale. We've made 380 of these first investments so far. I mean, you can see we're getting pretty close to that 500 number, which is sort of a good rule of thumb for where you start your portfolios. And we have if you're going to invest at that sort of scale, you can't afford to listen to hundreds of pitches. So the challenge for us is how do we get pre-filtered, pre-selected, high-quality deals out of these sources? INSEAD is a high-quality source, so great, we do things out of there. We don't listen to pitches, I agree completely. We do, however, do reference checks. And there is a gender element to this, and perhaps some of the women listening will relate to this, but if you ask a woman to talk about herself, there will often be some modesty. So when you get her to pitch, she will not necessarily be as braggadocious about herself as a man is. But if you ask a woman about her friend, she will be delighted to tell you how amazing the friend is. And this is one of the things when you do reference checks, you start to take the gender bias out of things. And for us, that's really important because we think there's a really valuable opportunity to invest in the best entrepreneurs. And if there's a process set up, which is systematically screening out good women, we want to be able to run a process that gets those good women into our fund. And we fund both women and men, but we want to have the sort of a screening process which makes the most money possible. Right. So that's one of the things we think.
So after I come in, let's say as an entrepreneur, because I come from INSEAD, and I get that first investment, what happens then about 12 months later?
Yeah, so what we do is we sit there, we do diligence calls with every company every month. And a big part of what we do, those diligence calls, are to understand the business in more depth. And it's also to be at the right place at the right time. Many VCs, there's a famous VC from Lightspeed, one of the Lightspeed partners was interviewed, I heard, and he said, people asked, well, how do you pick winners? It must be really tricky to pick winners. And he said, no, actually, often picking winners in venture capital is easy. When you see a company and their sales are growing by 40% a month, we have one company we just invested in Brazil, in INSEAD Alumnus, and the company went over a 4-month period. They do online tutoring, video tutoring, and they went from having 1% of their questions, people could choose a live tutor or an AI tutor, and the AI tutor is always reviewed by a human before the answer comes out. They went from 1% to 40% over a 4-month period of their questions being answered by the AI tutor. Okay. And you can imagine how much better that is for their profitability. So we're just in the right place at the right time because we're already inside the company.
And you then at that point choose out of those that originally received the $10,000, about 30 to 40% that will then receive the next largest check. And about 12 months later, once you screened them, having had calls with them monthly and having observed how they run their business, how they develop that amazing idea that they had in the first place. And it's about 30 to 40%, is that right, that will receive the next check?
It is. It's interesting, however, to look at the way that works, which is companies will stay in our portfolio for 10, 20, 30, 40 months before they get that next check. So you have between a 1% and 2% chance in any 1 month of getting the next check. Of course, if you have a 2% chance over 20 months, then that works out to a 40% chance. So that's where it ends up. But companies will spend years in our they can go very quickly. It might be a half a year and they've got the next check, but they could be in the portfolio for 3 or 4 years before they hit that turning point.
So, and just for completion's sake, the similar process then happens for the next check. So 10,000 the first one, 200,000 the next one, and then $1 million the third check, assuming the company has kind of jumped those hurdles and fulfilled the requirements that you and your partner put on them.
Exactly. And that's actually due to a very experienced limited partner pitch we did very early on. We were talking with someone, I think from ADIA, the Abu Dhabi fund, who'd seen hundreds, if not thousands, of venture funds. And he said, well, it's an interesting theory, and we've now got data to back it up, that you're going to do the longer you spend building up the relationship with the company, you're in the right place at the right time, you've got a good relationship to be able to put money into them. He said, but if this theory works, and at that stage we were only a 2-stage company, he said, if that works, then why are you stopping at only 2 stages? Why don't you keep going? Because you've got this relationship advantage, you've got this knowledge advantage, just keep profiting from it with check after check. And he was absolutely right. So as we thought through, so that's precisely it. We currently have 3 stages in our fund, and we are raising money to be able to start to roll out the fourth stage, because we have these relationships with companies, amazing opportunities that we know deeply, and we'll just keep picking the top 1 or 2% every month to give them a little more money.
Right. And so when you look at it from, let's call it a stage, from the $10,000 stage to the $200,000 stage to the $1 million stage, has the failure rate kind of stayed consistent in the since 2018, since you started investing?
The failure rate has stayed fairly consistent within stages, but it has been very different between stages. And that is one of the interesting things about the way we're running our model. Now, in venture capital, your failures happen moderately quickly. It takes about 3 years for the average failure to happen. And over about 6 years, you'll start to see most of the failures which are going to happen will happen within 6 years, whereas your successes take 7-10 years, and you might be 12-14 years before you see most of the successes. So we have very good data with a 6-year-old fund. We have very good data on failures so far. What we have noticed so far with the failure rate is we've had 60 companies fail out of the 380. Of those 60 companies that failed, 55 of them failed with only $10,000 invested. Only 5 of those who failed had more, and those 5 which failed were all at the $200,000 stage. No company that's gone beyond $200,000 with us has failed yet. And what this really does is this turns venture capital math on its head, because everyone talks about, the data I've seen is that 2/3 of your deals will fail, 4% of your home runs. There's this 31% of your portfolio which give you 3 times your money back. And of course, if 2/3 fail and 1/3 give you 3 times your money back, you're flat. You need those home runs.
Yeah.
But imagine for a second what happens to venture capital math if you don't have 2/3 failing, but you only have 1/3 failing. Well, then putting the home runs to a side, which will just increase your upside, your base doubling your money if 2/3 give you 3x and only 1/3 fail. And that's a little bit of what we think is happening with our model right now. And that sort of gives, it gives a great level of security to our returns, which is, okay, there's sort of a floor on the returns, because we just have fewer losses. And if you have fewer losses, then you've got a sort of base level of returns and you can go up from there.
So you basically have figured out a process that helps getting money into early stage companies at a significantly de-risked process. So you're de-risking basically the funds, and even the investments, even the ones that do fail, as you just pointed out with the data you have right now, fail at a very early stage. So that $10,000 ticket that you're buying to watch them as they start growing up is money well spent, one could argue.
Exactly. And it's actually interesting. We're de-risking in 3 ways. The first way we de-risk is exactly that. $10,000 is our first check. You spend months to years of diligence before you do any more money into it. And then you pick only the best 1 or 2% each month. And even though you may want to fund 5% of your companies, we write rules that you're just going to fund 1 to 2%. So that is the first de-risking. The second de-risking, and we didn't talk about this with the INSEAD network and the Founder Institute network, but there's pre-screening by these networks, there's pre-selection, but there's also a lot of value to having investments in people you have an existing network with. I mean, this is why people do friends and family at the early stage, because there is additional social pressure on the entrepreneur and the investor to act well. So there's a de-risking because people are more likely to look after those they're in a common network with. And then, of course, the third thing we do for de-risking is investing 101, which is diversification. And yes, we have 380 investments. Those 380 investments are across 60 countries. They're diversified globally. They are across stage of investment. They are across industries. Our largest industry is 12%. We have a little bit of everything in there. And if you follow those diversification rules, you will make any portfolio you invest in will be less risky if it is diversified. We all know the math to that one.
Okay. So it's with the 6 years of data that you have now, you have proof of concept on, it was an idea when we first spoke many moons ago. What are the challenges of running such a model? Because the evidence shows that it's working. So why are not more people doing it? And there are some out there, but clearly not a large percentage out of the venture universe.
Well, I think the things we apply, many people learn them. And if you look at Sequoia has been famous. If you ask them about what the secrets of their returns are, one of the things which they swear by is their scout funds, which is they give money to other people to go out and make a whole bunch of investments and give them privileged access to deal flow. And that's what those first checks do. They give you privileged access to later deal flow when the company does well. So people don't do that within a single fund. People don't do that with a sort of following on round after round. So they'll start off and they'll do fund one will invest in companies. And then for the later stage investments, they'll do a special opportunities fund. And the investors in the special opportunities fund get access to all this value created through the relationships built up from people in the first fund who don't get access to the returns in the special opportunities fund. And I think a lot of that comes back to the fund structure. Yeah. There is a predefined fund structure, which is you do a closed-ended 8-10-year fund. And I've just told you about it can take us 3, 4, 5 years for companies to go from one stage to the next. You could never do that in a closed-ended fund. Yeah. And we've been raising money into an open-ended fund with quarterly semi-liquidity. And I can tell you it is a real struggle for institutions.
Okay. Kamal, thank you very much for making time to join us today. So I think we learned a lot about the possibilities to de-risk early stage venture investing. It means to stepping outside the traditional path of closed-end funds a little bit, but it can be done and you have the data to show it. And as a side comment, which wasn't why we set up this conversation, but your model benefits female founders, or should I say non-male founders, is probably a more founders from a minority background. So thank you so much for that. And I look forward to having further conversations. Thank you for everyone joining us, and let me know any questions. Please put it under the YouTube channel.